Hey, this is Paul Roy, pauljroy.com, simplifying finance for you. Today, I am answering a question from my friend Jamie Chides and my other friend Kristen Meyer. They both asked about simplifying stocks. How do you invest in the stock market? And why is it that you can make money in this way? So if you've ever been on the internet or you've ever picked up a magazine or a newspaper, there's always some advertisement that says invest in stocks and you can make money. And these advertisements are correct. You can theoretically make money at it. You really can. In fact, a lot of people do. But more people lose at the stock market than win. And I want to talk about why. The fundamental reason that most people lose money on the stock market is because instead of understanding it, they just go in assuming that they're going to make money and they buy and sell emotion based and they end up just losing their shirts. So when it comes to simplifying the stock market, I'm going to start from the most simple thing, which is what is a stock? Because most people don't realize what a stock actually is. They think it's ownership in a company, or they think that it's just this magical piece of paper that somehow goes up and down, and if you buy it and it goes up, you can sell it and make money for free and go buy a Ferrari or something. I have met so many people and they have no idea what a stock even is, yet they are stock market investors. And it's ridiculous. So I'm going to talk about what is a stock so that you can understand what it is that you're buying. When a company needs money, and companies often need money, and they aren't generating that money from sales of their product or service, then they need some sort of outside investment. And really big companies do something called issuing stock, which basically is they offer a percentage of their company's profits in exchange for these little pieces of paper to the general public. And the general public, who for the most part is working jobs and doesn't really have time to develop a business, buys these pieces of paper because these pieces of paper represent future profits for the company. When you buy stock, you're not actually buying a chunk of that company. And many people think that you are, but you're not. What you're purchasing is the amount of the profits of that company that they disperse to you, generally in the form of a dividend. So let's say that you bought Coca-Cola in 1932, like right at the height of the Great Depression. Coca-Cola was not selling all that much brown fizzy water in 1932. But let's say that you held on to that stock for a long, long period of time. And now in 2015, you decide that you want to sell it. Well, it's going to be worth a heck of a lot more simply because you bought a percentage of the profits of Coca-Cola, and now the big piece of Coca-Cola is much bigger. So let's say in 1932, Coca-Cola was selling $20,000 a year. I'm pulling these numbers out of my butt. But let's say that in 1932 they were selling $20,000 a year worth of Coke. And in 2015 they're selling $20 billion a year worth of Coke. And you bought 1% of the profits in 1932. You are still entitled to 1% of the profits in 2015. So that's what a stock is. And that's why people want them. Now, the other question is, why do stocks go up and down? And that's simply because people perceive the value of a company to go up and down based on all kinds of other factors that you can't control, like the weather and the price of pork bellies and what's happening in China. And all of these other factors cause the valuation of a company to go up and down. The valuation is simply how much that investors think a company is worth. See, the company is still making the same amount of money regardless. It's just investors are confident or more or less confident on any given day. And so you will find that stocks go up and down depending on people's perception of the value and not always necessarily because the underlying company is more or less valuable. In the next video, I'm going to talk about why most people lose their shirts on the stock market. But I wanted to talk to right now really, really basic, what is a stock? Because a lot of people buy them and they don't know what they are, and then they lose money on them and they don't know why because they didn't know what they were buying. And it is exactly the same as going on eBay and buying a whole bunch of random junk and hoping that it goes up in price and then being surprised when it doesn't and then blaming eBay. That's what most people do with the stock market. So if you like this video, share it around and check out the next one. It's going to be about why most people lose money on the stock market, and most people do.